Well, you made it to the end of the week, and you made it to the National Real Estate Cafe with Don Gelling and Gino Fronte, where you get your daily dose of real estate market updates.
And today's dose is really interesting because Don chose to bring up what I think is probably one of the most controversial things you could bring up in the economy today. Most of the really smart people I know say we're in a completely deflationary environment, Don.
Well, we're going to talk about inflation. The reason we're going to talk about inflation is just to inform you a little bit more of there's different ways to measure it, but also it's going to be one of the prime factors you're going to hear over and over about whether we should be raising interest rates. And that's what the Fed is considering doing either September through the end of the year. So here's one of the main factors. Do we have inflation?
Right. So we look at two things. We look at PCE and we look at CPI. Those are the two main reports that the government's looking at to see what they're going to do or how much inflation we have. Now, for us, when we look at these reports, there's a lot of things we can dig into and say, well, this report isn't great, like because PCE, for example, strips out energy and food costs. Well, those are the two most volatile things that we have where we feel like we have inflation, right? Gas is through the roof. Last time I went to buy a potato, it was $3 instead of $2. It sounds like we have inflation, but you take that out, it's pretty tame.
Yeah, and then you got the CPI, and that strips out other things like healthcare costs that the government's covering, and that drags it down so it doesn't look as high. So the reason we bring it up is you're going to hear multiple inflationary reports. For example, the goal for the Fed, just so you know, is to keep our inflation levels, the amount of prices increasing at 2% or below. That is their goal, and that's actually been below that for quite some time now. But if you look at the reports, you'll see one that's at 1.3%, and you go, ooh, we're not even close to that. And then you see the other at 1.8%. Well, maybe we're closer than we thought. Bottom line is you got to pay attention to what really is happening in the markets and how inflationary it really is, how high prices are. And Gino's going to bring up something that's really important about owning a home and hedging against inflation.
Right. So what happens is governments need inflation. Inflation creates growth long term. So the reason we compare GDP to inflation is to see how much real growth we had above the inflation target. So if the Fed targets inflation at 2% and GDP's at 3%, we did good, right? We had some natural growth. But the reality is that the target is to have 2 to 3% inflation going on and to have growth above and beyond that. So if you buy a house today, a real estate with a mortgage, and your mortgage payment stays the same, yet everything else continues to inflate for 20 or 30 years, guess what happens to you? You get rich.
Oh, no. So is somebody calling you to get a loan, Gino?
I guess that was instant karma. Somebody wants to buy a house.
There you go. All right. So you can tell you these are live. All right. So let's give you an example of that, because CoreLogic just announced how strong the housing market is and the appreciation levels. They at the beginning of the year, there was a lot of projections at 4.5% or so. Gino and I thought it would be higher because we don't have enough inventory, and sure enough, we were right again. We love being right. It's at 6.5%. Across the nation. On the West, it's a lot higher than that. We'll show you that down the road too. But just give you some idea of what Gino was talking about. If you bought a medium home, sell price home, around the 236,000 range, which is say, and with this appreciation level, you would have earned $15,000 last year.
Not so bad, considering that the average person that's buying a $236,000 home has an average income of $55,000. So you're looking at least a 25% raise this year and potentially the same next year. Wouldn't you want to do that as many years as you possibly could?
So owning a home is another great. We keep giving you reasons why you need to take action. Okay, so what does that do to rates right now? We let you know that a lot of the factors that were pushing rates down, everybody worrying about the Fed and what they're going to do and all that. Bottom line is, the good news is a quote that Janet Yellen, who's basically head of the Fed, said is, hey, we are going to raise rates eventually, but it's going to be at a moderate pace. That eased everybody's concerns that it's going to be dramatic and change the economy dramatically. So rates have improved. So you can see here they have improved. Green is good, so rates were getting lower. And we said, but be careful. Heavy resistance, meaning we don't think they're going to get much better from here. And boom, here you go. Here's your new trending line, basically, for buying and selling bonds, which control interest rates. Good news is rates are better than they've been in quite some time.
Yeah, I like the new trading range. It's a smaller trading range, which means less volatility, more predictability, so that you know what you're going to pay for your mortgage and what you can get as return on your bonds, Don.
So take action before you see more red candles. Make sure you tune in daily to the National Real Estate Cafe, and you can get it straight to your phone by texting NREC to 58885. Have a great weekend.